Welcome back to Success with Steven, where we talk about financial literacy and all things personal finance as well as business. Now, today we're going to be talking about something that I think is one of the most important things that you could ever learn about when it comes to finance. And that is going to be 5 compounding assets that will make you rich. Now, this is going to be based off of 1 century of data. So in the last 100 years, these assets have worked. And while I'm sure a lot of you have heard of all of these assets, we always try to go to the things that sound like they're the newer, more appealing types of investment vehicles or things that we're hearing about right now. For example, like Bitcoin, which is a great asset, one that I definitely invest in. But there are assets that have been proven to work for the last 100 years. And if you go on Forbes list right now, I could almost guarantee a majority of the people that are the wealthiest in the world have done one of these things in order to get there. I can guarantee it, actually. I can guarantee it because you really can't do it without one of these types of investing vehicles. Now, that being said, I do think that, the earlier that you start and the more interested you get in this stuff, the faster you're going to see the results that you want. So know that this isn't an instant gratification type of thing. It is going to take time, but I do believe that no matter what you do, these things will become, they are invaluable. You really can't avoid someone telling you about these things. And I can tell you I've done it no matter how many times I've tried to look for other alternatives to try to get to wherever I want to be at faster. These were the things that kept coming up every single time. And no matter what, don't try to avoid them. It's better for you to learn about them and just jump into them as fast as you can. So let's get started. Now, the first thing I want to talk about is compounding. And what are compounding assets exactly? So compounding is a powerful investing concept that involves earning returns on both your original investment and returns that you have previously generated through your initial investment. And I'll explain this in a very simple way. But if you haven't heard this before, some people have called compound interest, or when we're talking about compounding assets, the 8th wonder of the world, because the way that it grows is so exponentially amazing that it goes over a lot of our heads. Now, from what I know, this seems so obvious to work that it almost seems crazy that not everyone is doing it at this time. So I want to start this off by giving you a very simple example that I'm sure you've probably heard. But would you rather double a penny every day for 1 month, or would you rather receive $1 million? And if this is the first time you've been presented with this question, then that's really cool that this is the first time that you get to see it. So would you rather have double a penny every day for 1 month or $1 million? And of course, I'm asking this question, so there must be some type of catch to it, right? So let's take a look. This is going to be a pretty simple diagram that's just going to show you if you doubled a penny every day for a month, what you would receive. And this is going to be a testament to the power of compounding an asset or compound interest. So if you start with a penny and double it every day for 30 days, you will end up with $5.3 million. And this is the power of compound interest, which means that the interest you earn also earns interest. So even though the penny is only going to double in value, the amount of money you have is growing exponentially. And this is a great example of how even small amounts of money can grow into large sums over time if you start early and let compound interest work its magic. So start saving today and let compound interest work for you. And even when, I know this is probably going to be annoying to some people, but even when they say, invest $500 into something like the S&P 500, it's really not a joke. It really does work. The problem is that when you're looking for instant gratification and then you don't know how it works, it seems like some impossible task. But in actuality, the more you learn about this, the more you're going to wish that you would have started it earlier. Like I've told this or I've said this same thing a lot of times on this channel, but if you were to just invest around $1,000 per month for 30 years, you would have well over $1 million. So imagine if you did that for your kid. If every month, instead of buying toys, instead of wasting money on things that they don't need, you took all that money and you just invested it, $1,000 into a compounding asset, especially one like in the stock market, you would have $1 million for that kid at the age of 30. And all they would have to know is how to maintain that portfolio or that account. And they would really never have to work technically if they didn't want to, or at least have the luxury of getting to choose what they want to do with their lives because they have that cushion. I mean, that's just one example, but it's so simple that when you see it, it's like, man, we could do this for anybody from the start of their life if we really wanted to. But back to the example. If you were to double 1 penny every single day, I know the example is very, very small, and I do apologize for that. But it shows you how on the first day, 1 penny, second day, we're at, 2 cents. By the time you get down to the 30th day, you start to see what compounding does. It just makes it just double, double, double. And that starts to add up fairly quickly. That's the reason why people don't see the beauty in compounding, is because you don't get the biggest jumps until the end. For example, take a look at the 15th day. On the 15th day, it was around $165,000 on the 15th day. You went from 165 on the 15th day, give it 15 more days, and now you're at 5.3 million. That's what I mean. Like, this stuff, once you get to a certain point, your interest starts to create so much more wealth that now you have more than the principal. What you put in, it just goes insane. So again, this seemed like magic when I really, really sat down, looked at it, and really understood it. And time is going to be the thing that will make this grow exponentially. And if you want this to grow faster, put more money in. But let's talk about the first compounding asset, high yield savings accounts. And I have talked about high yield savings on this channel. I have a video that I'm probably going to put out before this one. So I probably will talk about the best high yield savings accounts that you can get right now in 2024. But a high yield savings is a type of account that offers a variable interest rate that's usually higher than the rates available from a traditional savings account. Let me break this down. So according to a recent survey that was reported by CNBC, only 18% of Americans have a high yield savings account at this time. This means 82% of people do not have this type of account, which is insane to me. It's insane. This is a safe, easy, accessible way to create compound wealth. And if you were to deposit, let's say $10,000 into a high yield savings account with a annual percentage yield of 5%, that would mean you would earn $500 at the end of the year. And while $500 may not seem like a lot, what are you earning right now by leaving it in your savings account for your bank? What are you earning by leaving that money under your bed? How are you growing money that's just sitting there? So normally money depreciates over time. And what I mean by that is, with inflation, let's say you have $10,000 right now. Next year, you may only be able to purchase $8,000 worth of goods by how rapidly your money is depreciating. So you have to find a way to combat that. I mean, if you were only able to if you had $100 and normally that would buy you $100 worth of groceries, but now the same $100 you had last year only gets you $80 worth of stuff. Even though the money may be the same in your account, if I was buying eggs for $5 and now eggs is $10, it's costing double what it cost before. My money is not worth as much as it was prior. And you can see that. So a high yield savings account may not beat inflation per se, but it will help with the depreciation of your money. And traditional banks usually hover around 0.01%. So this would be earning you 5 times. And also think about this. If you had $500,000 and you put it into a high yield savings account, you would earn around $25,000 per year if the high yield savings account had a 5% APY, which right now they do. If interest rates start to go down, you'll probably notice that the high yields will come down as well, but then it'll be easier to borrow money. But these accounts are often FDIC insured as well, usually up to $250,000 for an individual and $500,000 for a couple. So if anything does happen to the banks, they collapse, whatever the case may be, your money is insured up to that amount. And you can make transfers as easily as transferring from a traditional bank. So it kind of doesn't really hurt when you can just take a certain amount of money, like let's say the $10,000, you're earning 5% on that at the end of the year, and you can transfer that between your bank account, usually in one business day. So I don't really see any reason why you would not want to do this. And a lot of people will end up using this and sitting money in these accounts, usually when they're trying to buy, real estate or property, and they want to have this money on hand. They'll just sit it somewhere where the money can at least appreciate to some degree. And the higher amount that you have, the more money you get back. I mean, it's incredible, and it's a tool for wealthy people, and they know how to use it. So when you have $1 million sitting in here and you're earning 5%, it looks a lot different than 10,000 or 5,000. So what I'm saying is the more that you do, the more that you put in, the greater the return will end up being for you overall. So just something to think about. Now, the next one on our list is going to be stocks. Now, historically, stocks have outperformed most other asset classes over the long-term period with an average of 10% per year. We just talked about a high yield savings account. If investing in the stock market has an average, and when I say average, I mean you can have 1 year where you're down 5%. You could have 1 year where now you're up 15. Now the average is 10. It goes up and down, but the point is if you leave it in there for the long term, like let's say you left it in there for 30 years, on average, you would have gotten a 10% increase from whatever your principal investment was. So historically, it's going to beat out all other assets. And I mean, that's kind of all I need to hear for me to actually know if this is 100 years worth of data. I'm not going to argue with the 100 years worth of data. If it's there and it makes sense, historically, it's going to work, right? So in investing, compound interest it's going to aid you as time goes on. Time is the biggest factor when it comes to this, especially when it's on your side and you are younger. So this allows for the potential of exponential growth to build your returns on money that you've earned. So again, let's take $10,000 for an example. If you were to take $10,000 in a 30-year diversified stock with a 5% annual compounded interest rate, and right now I'm talking about a dividend stock. And if you don't know what a dividend is, when you leave your money in a stock, they will pay you for keeping your money with that particular company. So if you were to diversify and you had a 5% annual interest rate return, and you left it in there for 30 years, you would have $43,219.42. Your initial $10,000 principal, plus you would have made $33,219.42 in interest. And conversely, if a simple interest calculation was used with the same investment, then it would result in the same type of gain. And what I'm trying to say is you can look at this with small amounts of money and it may seem like not a big deal, but you really have to look at this over the long term and see what happens. If, like, for example, someone may look at this and say that doesn't make sense, but yet you'll work at a job and invest in your 401k, and they do match you, but there's a limit to how much money you could put into a 401k. And then you work at a job for how many years until you're vested, and then you could take your money out for retirement? That's why I have to question it, because sometimes when we do things because we see everybody else doing it. But if you look at a 401k, is just a very limited type of investment account. It doesn't make sense, but people do that. How can this not make sense? You can make a lot bigger returns with the compound interest. I mean, you could use your 401k, of course. I'm not saying that's a bad. I think a 401k is a great tool. I'm just saying that if you can believe in a 401k, I don't see how you can't believe in this. It's literally, I mean, it just makes sense. And just so you know, a taxable brokerage account, which they call it taxable to turn you off from it, you can invest as much money in there as you want. 401ks and Roth IRAs have limits. So there is actually a limit to the amount of money that you can potentially make. If you have a taxable brokerage account, there's no limit to how much you could put into it. So the main thing is, and because I know people think, this works best when you have a either high paying job or you have a business where you can put and invest large sums of money. And for my example, everything I make from YouTube and most of the things that I do, I invest into the market. And from my calculation, and one day, I may put this up in one video. By my calculation, if I go the same way I'm going for the next 7 years, I'll have over $1 million in my portfolio, and I'll be making around $80,000 passively every single year. So if I wanted to retire on that fixed amount, I can. Knowing me, I probably won't. I'll let it go another 10 years or so I can get more money. The more it compounds, the bigger that it'll be. But I could almost guarantee that my retirement in 15 years, just from understanding how this works. So, I can't stress enough how I can't stress how important this stuff is, man. I cannot stress it. Okay. The next one is real estate. Now, real estate seems to be one that a lot of people like. I don't know if they understand it all the way, but they seem to like real estate. Everybody seems to like, maybe it's because property seems more tangible, but real estate has proven effective as a compounding asset. So real estate properties tend to appreciate in value over time. I think that's simple for people to understand. As time goes on, if the property value increases, then you will make more money off of that property the longer you hold it. And the more it can potentially increase in value, and this capital appreciation forms it forms the core of compounding when it comes to real estate. Now, the second way that it can be at least generate money will be rental income. So real estate investments often they'll generate rental income as property values and rental rates increase, because of course, as your property value increases, so will the rental rates. Your rental income can grow, and you can then reinvest this income into additional properties to get you more properties, compounding your investment even further. And the third is leverage. So many real estate investors use leverage or borrow money to acquire properties when property value increases. And you'll probably notice this with HELOC loans, home equity lines of credit. And you don't have to do this with just retail property. You can also do this with commercial property. It just depends on what you're looking at. But real estate is definitely one of the biggest driving factors to creating wealth for new millionaires and people who are just starting to come into a large amount of wealth. And I just want to use this example here. How much can real estate make you? So over the last 200 years, 90% of the world's millionaires have been created by real estate. 90%. That should tell you enough right there. So one unit can potentially make you $1,000. 10 units can potentially make you $10,000. 100 units can make you 100 million. 1,000 units can make you $1 million. And 10,000 units can make you potentially $10 million. This is, of course, just a very rough estimate. And what we're looking at is what it can make you per month if you had those many units. So, I mean, that's pretty good. And while I know if you're looking at this and let's say you're just starting from zero, you're like, man, I'm working a job right now. I don't even have enough money to actually invest or do any of this stuff. I know this probably seems like, oh, that sounds great, but how do I get there? Again, on this channel, that's what we talk about. So if that's something that you be interested in, then drop a comment and I'll be more than happy to talk about that. But even when I talk about real estate, if you watch any of my previous videos, I always talk about cash flow. These are all assets. Before you start purchasing assets, you need to have cash flow. I don't believe that, in my opinion, I don't believe real estate should be a cash flow when you don't have any money, because real estate is not predictable like the stock market. You can't just say, oh, I'm going to buy this house and then next month I will just keep making $1,000 forever. You don't know that. So I like to have cash flow. So I like to have a business here, this here, your job here, whatever you can do that produces income. And then you take the income from all of those and then you put them into assets. Just like what I said with YouTube, I practice what I preach. All the money I get from every single thing that I do, I buy assets with, and then it'll be property too. So no matter what, this is the exact same thing that I'm doing that's going to have me retired early. I'm going to just take all the money I get from businesses and all that cash flow, assets, nothing but assets. Remember, this is an asset. So produce cash flow first from your business or your job, whatever. And a job's okay too. Work your job, do overtime, whatever it is. If, some people business is just not for them. They just may not want to do it. So you can still trade money for time. The more money that you can produce, I would say you have to be really good with budgeting. And you'd have to put all of the extra money that you have into investments. And eventually it will pay off. And that exponential growth of your assets compounding will eventually take you out of your job. So a job is perfectly fine too, as long as you have cash flow to make sure that you can maintain your assets in the future. But definitely real estate is one of the best ones. Now, this is the one that I primarily lean into the most: index funds and ETFs. So we're going to mostly talk about just ETFs, but mutual funds and exchange traded funds represent a popular way for investors to diversify, but they have some key differences. While ETFs can be traded intraday like stocks, mutual funds can only be purchased at the end of each trading day based on a calculated price known as the net asset value. Now, mutual funds are, I feel like, a little more mature, and I would say ETFs are better to start with. So ETFs are a basket of companies. You don't just have one company that you can invest in. You get all these companies that you can invest in. And when you do that, it diversifies everything. And they're usually broken up into different industries. I actually have another video that I may try to release it before this video, but I talk about the best ETFs that you could buy and hold forever. If that video is out right now, I recommend that you watch it. I think it's really good. I spent a lot of time doing the research on it, and those are also my ETFs that I choose to invest in. And I think that it's a really good diversified pick. And I think if you look at any ETF video, you'll at least find 70% of the ones that I picked. I would say 70%. You'll find most people look at those ETFs, if you needed a place to actually start. But the great thing about ETFs, besides the diversification, is there are ETFs that primarily focus on dividends. So I do this thing called DRIP. It's where your dividends get reinvested back into the same ETF that you purchased. So every time I buy ETFs, I'm also earning money, not just from the market going up, but I'm also earning money from the interest that these companies are giving me from investing into them. And again, it's a basket of companies, so I'm very diversified. I'm not leaning too much into one sector of the market. Like, I'm not too much in technology. I'm not too much in semiconductors. I'm not too much in healthcare. I'm very balanced. But over the long run of, investing and over the long run of compounding assets, you are going to see huge benefits with this. Throughout various videos that I've made, I've talked about this. Passive income video, my savings video, I've talked about this so much. I think it's one of the most important, underrated things that you can get into. And I think the worst thing is that we get into it late. That's probably the worst part about it. If you were to start doing this at 18, potentially, and it all varies. But in my savings video, I actually show when you're 18 years old, if you were to invest that $1,000, what does that look like for you by the time that you're 40? I mean, it's crazy because, again, people gonna think, oh, that's a long time, but it's really not. It's really not. And if you can just make more, I'm saying if you're just a regular person that works at Walgreens, this might still work for you for until you're 40, and then could get you potentially retired. Still, I mean, that's to me, that's amazing for someone who just worked a regular job. And if you are someone who wants to make a little bit more money and you could put more in, it just will make that happen a little bit faster. Your money will compound that much quicker. So definitely check that out if you haven't. But if you do have an interest and you watch my ETF video and you want to learn more about ETFs, maybe get more of a like an even more comprehensive guide and understanding of that, let me know in the comments. I will be more than happy to do that for you. All right. And our fifth compounding asset will be bonds. Now, unlike stocks, bonds don't give you ownership rights. They represent a loan from the buyer, which is you. You're getting a loan from a company. And the bond will give you lower returns, but they're usually safer investments. But you get this loan from a company and they promise to pay you back the full value of the money that you loaned them with interest along the way. All right. So bonds are issued by governments and corporations when they want to raise money. And again, by buying those bonds, you're getting that loan, and they will pay you back at face value on a specific date. And then they're going to pay you periodic interest payments along the way. And usually it's twice a year. And you don't necessarily benefit from the company's growth, but you won't see as much of an impact if the company isn't doing well either. So there's even bond ETFs, but you kind of want to be diversified. So that way, if the company does bad or good with the bond, it won't really affect you. It doesn't really matter. They're going to pay you on those specified dates. They're going to pay you. So bonds will give you two potential benefits. When you hold them as part of your portfolio, they give you a stream of income that can offset any like volatility in the market. They give you passive income and they offset any volatility. So those are the two benefits that you get. So if you were to invest, let's say $100,000 in a bond, and you were getting an annual interest rate of 5%. The bond has a maturity, let's say, of 10 years. And a bond's maturity, it refers to the length of time until you get the bond back at face value, like you get your money back. So let's say your maturity date is 10 years. If you were to reinvest interest each year at 5%, year one with $100,000, you'll get $5,000 in interest payments that you can reinvest. Now your new principal is $105,000. Now in year two, if the interest is calculated on the new principal, you'll make $5,250. Now your principal just turned to $110,250 because every year we're gaining and we're adding on to what we initially started with. If we gain 5,000 in year one, we get 5,250 in year two. We're now at $110,250. All right. So if you keep going and you let it go for about, let's say, the full 10 years and you kept reinvesting your money, by the end of year 10, you'll have anywhere between like 165,000 to 170,000. And again, while that seems like it's not really like a lot of money for the time frame, how I'm looking at this is if I have a business and I'm making great money and I want to be diversified. Like I may have all of this. I may have a little bit of stocks, a little bit of real estate. I may have a little bit of, I may have bonds to give me a safe one where it don't matter how anything is doing, I'm still going to get money here. You diversify that way. You're not too exposed to one thing, where if that one thing, something bad was to happen, now you would lose a big chunk of your investments. You always want to be diversified and have these different compounding assets. Another thing is, when it comes to the stock market, if you look at some of these growth stocks and you look at some of these growth ETFs, some of them have given you back almost 15% in 20 years. Some of them have given back 20% in the last 5. That's really, really good. I mean, if you had 100,000, you would have made $20,000. Not to mention, if you got dividend interest, it just keeps going to the point where it's like, this is amazing. This almost works like magic, like how much money that you can actually get. So let's just talk about the benefits that you could get from doing this. Exponential growth. The earlier you start investing, the more time that you have to compound. As time goes on, the rate at which your money grows will accelerate. Again, I know when people say you can start off small, it sounds like silly, but no joke. You can start off with $500. The thing is, time is going to be the factor here. Time and consistency. Put 500 in, keep it in, keep doing that every single month for 20 years and look at what's going to happen. In 20 years, I don't care if you're 20 years old, when you're 40, you're still going to probably feel like you do when you're 20, and you're going to want to make sure that you have money to live, to have fun, to like do things. Don't just think about the here and now. I know that's hard, but have a mindset for the future. Again, you're going to still be here at 40, God willing. And trust me when I say, especially because I've worked at a few different banks and I've heard people who were much older on the phone in tears crying because their prescriptions went up, insurance went up, and their retirement is $100,000, and that's all that they have to live off of, that in Social Security. I've heard all the phone calls. I've heard all the regrets. I've heard what they wish they would have done differently. I cannot tell you how many times I heard, I wish I would have done this. I wish I would have invested. I wish I would have bought more property, more real estate. I can't tell you. I'll never forget it. So I'm telling you. And passive income is the other benefit. Compounding allows you to generate passive income by reinvesting. You create a cycle of generating more returns, which can be reinvested again without you working. You will get to a point in this compounding asset journey will eventually your interest, the money that you're reinvesting, will start to become more money than what you were even putting in yourself. And that's that snowball effect, where at the end of it, your money's making money. You've done it. All you have to do is just sit back and just collect. At that point, you're done. There is a point that everyone can get to, and you could be the guy that works a regular job and with enough time and consistency in the market, or enough time and consistency purchasing compounding assets. You will get to that point too. It doesn't matter if the guy who had a trust fund and he did it in 5 years, or you did it in 25 years, being diligent and working. We all don't start at the same point, but you can end up in the same place just by being diligent and staying consistent. The other benefit is you get to beat inflation. So inflation, it erodes your buying power. And like I said, meaning if you had $100 this year, you may only be able to buy $80 worth of goods next year. I remember, I was to give you another small example, looking at McDonald's. What happened to the dollar menu? I used to be able to get a bunch of stuff for a dollar. I remember when large drinks were $1. Large drinks are $1.69. That's inflation. So if the year prior you were able to buy a large drink for $1, and now let's say next year it's $2, that means it costs me twice as much to get the same large drink I could have gotten for $1 4 or 5 years ago. That's inflation. That means that your money will only buy you half as much. And that was a very short amount of time that probably happened. So that's just an example of how we don't pay attention to it on a daily basis. But when you look at that, or you think of, I used to just have to spend this much for gas. I remember I could fill up my tank with just get $20. It used to be gas money, not $20. That's when we complain about that, but we're not consciously aware of what's going on. That's inflation. That's the erosion of your money. That's what happens when you just save money, which is why I always recommend don't save, invest. And then not only invest in compounding assets that can take your money and grow it so you can beat this thing, And discipline. One thing that I've learned over the long term of trying to get money fast, trying to take every shortcut I can. And one of my friends had told me, he told me, if you keep cutting corners, you'll run around in circles. And he's right. If you cut the corners, you run around in circles. You won't get anywhere by doing that. And I figured that out at some point and gave up trying to do it the fast way. And I just said, I'm just going to work diligently. And that's going to get me to where I want to be at whenever it gets me there. The faster you can learn that, I could promise you'll be in a very different place than you are now within the next, 10 years or so. So watching investments grow can teach you patience. Watching your investments grow over time can also instill the importance of always staying invested. And all I could say is go for a year and invest money into one of these compounding assets for 1 year. And then look up in a year and then look at how much that asset grew. Now, again, it's going to be some years where you may be in the negative. That may be discouraging, but let's just say, hopefully, in this situation, you saw very good growth in that last year. That's going to give you the battery in your back that you need to know I can keep doing this. Because if I keep doing this, by year 2, I'll be here. By year 3, I'll be here. By year 4, you'll be. And then you'll start to understand exactly how important it is to stay invested and to not spend that money frivolously, and to know that you're doing something that will benefit not maybe you in the moment, but you in the future. You really want to think about that. Not to say you have to sacrifice anything in the present. I believe there is a balance of being able to do what you want now and also being able to secure your future. Because I don't plan on missing no meals. I'm going to have fun now by making a good amount, but I'm also going to make sure that I invest into these investments, and I will stick to my rule. And if my rule means I have to invest 70% of what I make, that just means with that 30%, I better make $100,000 a month or something crazy if I want to be able to have fun. That's all that means. That's how I see it. I see it as simple as that. Well, if I want to have fun and do what I want, guess what? I got to make this amount of money, because no matter what, this 70% is getting invested no matter what happens. So, all I can say is thank you guys for watching. I know that videos where you talk about investing for the long term, and videos where you talk about being disciplined, and videos where you talk about growing wealth are not popular. People don't want to hear that. Everybody wants to be instantly gratified. I know that that's really, really popular. Everybody wants the $1 million side hustle. And while I do think that, that can work, even with those people, even if they made all that money, if they're not investing it, who knows if their side hustle will continue to work. There's a reason why people who win the lottery end up going broke. You were thinking they had so much money, but they didn't know how to manage it. They didn't understand taxes. They didn't understand what happens with inflation. There were so many things they didn't understand about keeping money in circulation so that you can maintain and grow that wealth, that caused them to end up right back in the same place. So even if you have a great side hustle, or you were able to make $1 million in a year, at some point, you're going to have to learn how to make that money work for you instead of you working for that money. It doesn't make sense. So again, I don't believe instant gratification ever gets you the results that you want. Not to say that it can't work, but at some point we have to do the things that are going to get us long-term results. And that's just what this was. And I can guarantee that if you stick with these, they will make you rich in the long term as long as you stick with them. And thank you for watching this overly long video. And thank you for if you made it this far. I do appreciate you. Let me know in the comments if there's one of these particular assets you want me to deep dive, you really want me to like dig into, you want me to break down. I would be more than happy to go into detail about any one of these assets. If you want to make any recommendations, maybe do a tier list of some of the best compounding growing assets, I have no problem doing all that research and presenting it for you so that you can make a better decision on which one of these compounding assets you want to do, even though I recommend them all. I do understand that there are different levels to them. Bonds, ETFs, stocks, and high yields are things that we can get into now. And I think real estate, with the cost of what it takes to get into real estate, and also credit requirements and income requirements, I do believe that that's like the last one that you should do. But the other ones, it's open season on the rest of them. I recommend that you get into one of those as soon as possible. Thank you so much for watching once again, and you guys have a great day.